Good morning. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey.
It's 10:02 Pacific here, Friday, February 21st. It's President's Day week. Short week, not a lot going on. Want to give a shout out to the U.S. men's national hockey team, which fought a valiant battle but suffered defeat. And got to give credit to Canada where credit's due. They snuck that one out in overtime, so respect to them. And we'll kick off the week with where we are in markets. I would say it's been a relatively quiet week, but we've had some moves. In equities, the S&P 500 is down about 1% on the week, and it's a bit of a mixed bag. You have some dispersion across sectors there. The worst sector by far is consumer discretionary, down over 3.33%. Quite interestingly today, there was some news out of the health insurance market that a major health insurer is being investigated by the Department of Justice for Medicare fraud, and their stock is down almost 10%, but the healthcare sector on the week is up about 1.25%. because pharmaceutical companies have had quite the week. So even though there's that drag from the insurance part of the healthcare sector, interestingly, the healthcare sector is up. The big winner on the week looking right now is the energy sector, up almost 2%. So that's pretty interesting. The energy sector is actually up 7% year to date, and it's the best performing sector this year. So kind of a bit of reversal of fortunes. We'll see how that pans out as the year goes on. Tech and communication services both down. Tech down about 1%, communication services down 1.7%. So one of those weeks where equities are down. You go down to the small caps, and the Russell 2000 is down 3%. So bit of pain there. Value is outperforming growth, and we'll kind of leave it at that for equities unless you have something to chime in, Mark.
You know what? I'll say that it's what a difference a couple days can make. I remember on Tuesday and Wednesday, throwing our macro chat that we were hitting new all-time closing highs on the S&P, and here we are ending the week, like you said, down over 1%. So we'll see where we close today. But we're coming off the high water mark. So like I said,
that's definitely true. And realistically, you got to see how these trends pan out over time. Valuations are definitely stretched, and like you said, we're up there near the stratospheric highs. So
yep.
a little bit of correction wouldn't be too surprising, in my opinion. I mean, the S&P is trading at 60.46 right now, and the 200-day moving average is down, way down there at 5,700. So I think the market has, it can clearly, drop down to the, 6,000 level as a test, and we'll see what happens. But you never know. You just got to keep your eyes peeled, keep your eye on the ball. Moving on into the bond world, you got a little bit of positivity this week with the U.S. aggregate up about 40 basis points on the week as of the recording of this podcast. If you're looking, into the sector areas, the lone loser in fixed income land is emerging market bonds. They look like they're down about 15 basis points. The big winner is mortgage-backed securities shining a little bit. They're getting a bit of luster, up 50 basis points. So that's positive news. Looking at the yield curve on a week-to-date basis, you're seeing, the long end has rallied a bit on the back of the Scott Bessent's comments. There's been a lot of rumors swirling regarding, these Mar-a-Lago Accords. Is the U.S. government going to impose some sort of restructuring on the U.S. debt? And it's all rumors, in my opinion. And really, Bessent came out and said, look, the U.S. isn't going to start issuing a lot of long-dated bonds. We're not going to change the modus operandi that we've been operating under. And that kind of settled the market a bit. And you've seen that rally in interest rates on the back of those comments, in my opinion. So, pretty positive week in fixed income. And then rolling over to commodities, kind of looking at the aggregate level, the Bloomberg Commodity Index is up about a little over 1% on the week. Precious metals are up 1.6%, And, gold hit all-time highs this week. It's currently sitting at $2,935, so quite a lot of shine coming off the pet rock right now.
It's glimmering.
Yep. Crude oil sitting at just south of 71. So 70 handle on crude oil. And Bitcoin, for all the crypto maniacs out there, at 97,000 is down about 0.4% of the week, but they just shrug that off. That's nothing in crypto land in terms of volatility. And the best performer on the week has been the energy subsector, which is up about 3.3%. So that kind of rounds out where the markets are. And we can jump into the macro for the week, unless you have any insights on the market moves that you've observed, Mr. Kimbrough.
I'll keep it there. There's something that's kind of going to run into that with where I start with the FOMC meeting minutes, but I'll get into that in the macro. It's not too market implicative. So what? Let's run right into that. Again, short week. On Wednesday, we started off with the FOMC meeting minutes, and there's 2 points in here I'll highlight. The one that's called market related, there was various participants noting that it could be appropriate to consider pausing or slowing down the balance sheet runoff. So we could have a pause or a slowdown in QT. That is, that's removing a headwind to bonds, or just getting us back into a normal stretch. So I thought that was an interesting takeaway from the minutes. Also, there's just a quote, and I think this applies to a lot of economic data. But I'm going to read this quote. It's a short one. Quote, "It might be especially difficult to distinguish between relatively persistent changes in inflation and more temporary changes that might be associated with the introduction of new government policies," end quote. Basically, yeah, like this shows up in some of the data from this week, but just being mindful of some of the volatility that can come either in reaction to or anticipation of, expected policies or the talk of policies. So just some of the Fed's noting is you may not want to trust a single data point. You might want to see that trend develop and not get too over invested in singular data points. But moving forward, we're all the way to Thursday already. We got initial jobless claims the week ending February 15th, and continuing claims the week ending February 8th. Characterize this as steady as she drifts. Initial jobless claims came in at 219K. That was 4K above estimates, 5K above the prior. The 4-week moving average dropped by 1K. Similar story here for continuing claims, printed 1.869 million, still being able to hang out under that 1.9 million ceiling. The 4-week moving average is at 1.863. It dropped 7K this week. So again, steady as she drifts for our more high frequency job data. Also on Thursday, we got the leading economic index, the LEI, for the month of January. This printed for the month-over-month figure, negative 0.3%. That was 0.2% below the estimates, 0.4% below the prior. That results in the year-over-year number actually rising by 0.2% to negative 2.6%. It's actually the least negative print we've seen since September of 2022. And one of the things we talked about whenever we bring up this indicator, we talk about their signals. They give warning signals and recession signals. And I always give a reminder on this. There's 2 conditions that must be met to have a recession signal from this index. That is, your 6-month diffusion index is below 50, and your 6-month growth rate annualized is below negative 4.3%. Well, we are above on the diffusion. We're above on the growth. The growth is negative 0.9%. And so the warning signal is removed. They actually revised December data as well and removed that warning signal. So I think it's the first time in many years we've not seen the warning signal or the recession signal given. And in line with that, the conference board now forecasts a 2.3% real GDP growth for the month or for the year of 2025. Closing up the week.
Not too shabby, but you're getting some mixed stuff coming out of the S&P stuff that you're about to talk about.
Yeah, that's the S&P Global. This kind of all ties in with all of this. It kind of is a little counter to the I call it that rosy 2.3% real GDP growth coming from the LEI. We get S&P Global PMI data for manufacturing, services, and composite. We'll run through the numbers real quick. The manufacturing data came in at 51.6. That was 0.2 above estimates, 0.4 above the prior. This is actually back-to-back months of expansionary prints for the S&P Global U.S. manufacturing PMI. We also have the services metric. This surprised to the downside, coming in at 49.7. That was 3.3 points below the estimate and 2.2 below the prior. That snaps a 25-month streak of expansion for services for this metric. Last time we saw sub 50 was Jan of 2023 at 46.8. So we just limboed under that 50 bound here. But look, let's look under the hood and see. It's not ideal to see that considering how much of the economy is based on services, but it's been a good stretch. Let's get to manufacturing first, actually. This improvement in manufacturing, it was supported by an expansion in new orders. There was increase in production and demand. It was actually noted to be linked to front running of potential cost increases or supply shortages linked to tariffs. So
do you think that effect is going to be just a one-off shot because of that reality?
That is exactly the reason I gave that little quote from the Fed. Even though they were speaking of inflation, it could be a one-off. It could be persistent for a little bit, considering these tariffs. We don't know what they're going to be. I mean, they've been laid out, but we don't know exactly what's going to get implemented given the negotiations that are occurring. So, given that uncertainty, people choose to act, and they also can choose to sit on their hands, which is something the services sector did. The services, we had a deceleration in new order growth. It was, positive, but the weakest we've seen in 10 months. And the report actually specifically noted that pullback was commonly noted to be linked to political uncertainty, specifically around spending cuts and the impact on growth and inflation. So just as you just asked, I mean, you could have a one-off here on the manufacturing. You can't sit on your hands forever for services, but they can also have a one-off. We'll see how this continues to develop. You don't want to extrapolate your 1 point of, our 2-month streak of manufacturing being a winner and our 2+ year streak of services being a winner getting snapped. You don't want to assume that that's just going to be the new trend just because, we're seeing so much vol and a turning of kind of policies right now.
Yeah, and I mean, I think that's a good point you make regarding services. As much as there's all the hoopla around Doge, when you do the GDP calculation, it's plus government spending. So if you cut government spending, GDP will go down. So
Yep.
I think people need to realize that. I mean, look, there's the problem in the United States. We live beyond our means. We have massive budget deficits, and that needs to be addressed. But there's going to be some short-term pain. And if Doge is able to cut government expenditures, even a fraction of what they're aiming to do, I do think that's going to lead to a reduction in GDP. So that's just something to keep in the back of your mind
Sure.
out there.
That's to close up that rosy deal right here. I'm actually going to close with a quote from the chief business economist for the S&P Global PMI report. It says, quote, "The upbeat mood seen among U.S. businesses at the start of the year has evaporated, replaced with a darkening picture of heightened uncertainty, stalling business activity, and rising prices," end quote. So yeah, not the most
That's
rosy
pretty
outlook
gloomy,
right there.
man. That's pretty gloomy right there.
I mean, darkening picture. The upbeat mood is evaporated. Not the quote you want to read on a Friday morning, but that's what we got from S&P Global. So you have to contend with this. The data is the data, and if that's what people are saying in these surveys, look, we take them in as survey data, so you're taking it, in stride.
Yeah, and I mean, I think that's right. You have to take it in stride. You can't get too excited about one data point, but definitely maybe there could be an inflection. So we got to keep our eyes peeled on this. Pulling it into the Fed, I mean, on the back of their minutes release, you saw the rate cuts kind of even get pushed further out in time. I mean, you don't even have, according to the interest rate probabilities, 100% chance of a hike by July. You're not even seeing that till September now. So, definitely the 1 to 2 cut year looks to be the consensus of the market, but obviously Mr. Market gyrates, so that's subject to, next week's inflation data that's going to drop. So why don't you guys check out that why don't we roll that into what to keep an eye on for next week, Mr. Kimbrough?
Well, you know what I will do, but forgive me, but I'm going to bring up something I normally don't bring up, and that's the 5 to 10 year inflation final print. It's the University of Michigan usually don't like to talk about it. This is sentiment data, it's survey data, but they usually like to look at the preliminary prints. You get that data, you get the hit to the market, and you see what you get. But the 5 to 10 year inflation estimate was revised up from 3.3% to 3.5%. Again, don't always put the most stock in these survey data, in these different survey data points. But Powell has mentioned this particular data point in the past, so it's one we look back to every now and then. This is actually the highest we've seen this metric at 3.5% be since April of 1995. And that was when we were recovering from the local peak of inflation in 1980. It was riding down that entire time. So I just wanted to bring that up. It's actually, that does stand out. I've mentioned these here and there.
I agree with you. It does stand out. And I agree with you that it's important because inflation expectations are one of the biggest drivers of future inflation, right? If you think things are going to be more expensive in the future, you're going to buy something today instead of waiting. And I take it with a grain of salt because right now, like eggs prices are stratospheric, and there's even egg curfews in the sense that you
It-
could
it-
only buy a certain number of dozen. And these sort of things, I mean, are affecting people's psyche. So I agree with you. It's important to watch.
like
But we do have to take it with a grain of salt.
For sure. Like, but let me speak to the anecdote because it was funny. My last trip to the grocery store last weekend, there was a guy who was manning the post basically in front of the eggs, ensuring you only took one carton. And if anyone tried to take more, he's there to basically slap your hand and tell you no to get ahead of the register before you get there. So it was entertaining to
I
see a
mean,
guard
that's
on
next
watch.
level. I just saw a sign, limit of 3 per customer, but you actually had a guard there.
Oh, he was standing next to the sign. They had the sign up, but that wasn't enough. This was a trader. I'm not going to say the company, but it was a place I go to frequently, and it was entertaining to see.
Well, yeah, definitely on the consumer's mind in that 3.5% print of the 5 to 10 year inflation expectation is aligned with the fear of higher prices out there. So let's kind of roll to what we have looking forward next week. I'll start it off. On Tuesday, we get the S&P Core Logic data for the real estate market. The priors have been good. The real estate market's been growing. This week we got the data on the sales are pretty abysmal still because just prices are high, rates are high, so people don't want to move unless they really have to. We also get the Conference Board consumer confidence coming out. The estimate there is below the prior, which I wouldn't be surprised if that's correct or if it's even lower. And then why don't you tell us what we're going to see on Thursday and Friday, Kimbrough?
On Thursday, we get the second estimate of Q4 GDP. That's estimated to be unchanged at 2.3%, still firm. Also on Thursday, we get some manufacturing data. We get durable goods orders, durables ex transportation, the capital goods orders non-defense ex air, and the shipments non-defense ex air. We expect a little volatility out of the durable goods, 2.2%. It's bouncing off the prior negative 2.2. So we'll see if we get a little constructive manufacturing data here. Can kind of ride that PMI wave we just saw. Also on Thursday, initial jobless claims, continuing claims. Again, steady she drifts. I didn't see any estimates this morning, but that's been the case. And then we get to Friday, the big day. As Dhall mentioned, we have inflation data. We have PCE, called the granddaddy of them all. It's the core number is estimated to come in at 2.6% year over year. That's a 0.2% decline from last month. The estimates usually are pretty good right now, so we'll see what we get. But a 0.3% month over month number is expected for the core month over month figure for the month of January. And also we get personal income and personal spending. Both are estimated to come in a little weaker than last month, a little weaker than their long-term trend, but we'll see what the details show us. And that kind of wraps up the week.
Yep, that wraps it up this week. I think it's been a pretty quiet week, but we got some stuff to look ahead to next week. So stay tuned.
Yeah, thanks to our listeners out there today on DL Minutes. Hit us up on the X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine on our website, doubleline.com, and don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. Catch the latest episode of Channel 11 there with PM Kem Chinoda. Also, we had PM Morris Chen on Bloomberg TV, and that was a pretty good interview, so check that out as well if you get a chance.
Indeed. Thanks, everyone out there, and stay safe.
Yep, thanks to our listeners out there, and have a great weekend.